Hello, Jeff Green here. Welcome to another Monday market update. And we're going to go through things that are really bothering a lot of people. I get a lot of questions on these sorts of things this week. We're going to go through them with some support in the numbers. The media reports that the Phoenix market is crashing. Crashing is sort of a term that makes everybody very, very nervous. Is this like 2008? No, I don't think so. Not yet anyway. And we'll go through some numbers to help you understand what is going on in the market. Foreclosures are not currently an issue. If you think back to the 2008 time period, boy, there wasn't more than one house in every six that was in foreclosure. That's not the case now, and numbers are not indicating that that's going to increase, but we've got headwinds in front of us, including increased interest rates. So supply and demand is becoming more balanced. Gosh, even 6 months ago, most of the houses that were on the market were sold on the same day, or maybe the day later when sellers could get to the 25 or 30 offers that they had once the sign was in the front yard. So days on market are becoming much more normal. Instead of 2 or 3 days on the market, we're getting up to several months, which is normal for real estate markets. It takes time to sell houses in a non-feeding frenzy sort of environment. And lastly, but not least, higher interest rates are certainly having the desired effect. I have some reservations as to whether higher interest rates will reduce our inflation, but it's certainly having an effect not only on the real estate market, but on the economy in general. So let's look at some numbers. This is a summary. I use Cromford Market Index in my business significantly. It's a way to summarize the armless numbers for easy digestion. So we'll see the supply index. Let me get a pen here. See the supply index right here, the market index here, and the demand index. And generally, these work as you would expect them to. If the needle's in the red, that means we got an oversupply. If the needle's in the red, that means it's a buyer's market. And if we've got a red over here, demand is lower. So green is good, red is bad. And this market index here summarizes where we are. So you can see we're right in the middle here, sort of torn between a buyer's market in the green and a seller's market in the red. Any numbers below 100 or around the 100 is sort of a balanced market. So let's look at the supply index trend for the last 30 days. You can see the supply has gone up, and I think just about everybody has experienced more homes coming onto the market. I think most people know that that's going on. The market has decreased. Market activity has decreased into more of a balanced market. And the demand index certainly has come down minus 4.3 points. So interest rates are causing this, and the more supply, people are probably still trying to move and maybe capture some of the huge gains over the last couple of years. So let's jump into the slides here. Okay, so we're not going to go through every one of these numbers, but I do want to point out some interesting statistics. Let me see if I can get a pen here so I can I do that? Yes, I can do this. Okay, so active listings, you can see active listings are up. Today they're almost 23,000. A year ago they were about half that. So you can see that that's what sort of caused, if you don't have a reasonable amount of supply, then buyers just get crazy, especially when interest rates are so low. Sales per month, last month we were at about a little bit less than 6,000. Last year, 9402. Even though supply was down, didn't take much to sell a house. Just pound a sign in the front yard, you would get offers. So it's a little bit more challenging, but I wouldn't say it's a buyer's market yet. So if you're looking to get into a house, certainly this might be the time to consider that. Days on market, sales, active, under contract with backups. Certainly these numbers are certainly greater than these numbers. So we are seeing an extent on the days on market. So let me give you a minute to peruse those numbers, and I will change to my regular mouse. So these are very detailed numbers. Now, I can go over numbers like this for zip codes, neighborhoods, cities, even in even more detail. So if you're interested in that, just give me a shout. But these are the numbers that ended up today. What's interesting here is the average price is now at 546, where the median is at 435. So you can see it's pulled back from last year, right? So 40%. Let's see, about 40,000 over 515 is about 10% in my book. So price of pullback 10%, and maybe a little bit less on the median price. So I don't consider that a crash. I consider that a pullback. But the media likes to shock and all with all sorts of nerve-wracking verbiage. So let's take a little look at the numbers. Now this is an interesting chart. The red line is the demand index. So this is the demand for homes that are on the market, and you can see that in the 22 in this time frame in here, that's when the feeding frenzy started. Demand went up, and the blue is the supply. So even in economics 101, you find out that when the supply decreases, when the supply decreases and the demand increases, prices go up. There's no secret there. That's what happened in the last couple of years. So we'll, this is showing that the balance is a little bit more to the buyer side. Now, what happened back in the 2006-2007 timeframe, if you remember, this is the foreclosure curve here. Supply went way up and demand came way down. So are we going to see this again? I think we'll have to wait and see. If you have viewed my other video on when I think interest rates might ease in the early to late spring next year, or late spring, early summer, if I remember, April to the June timeframe, if prices don't continue going up, I think that might give the Fed some leeway to start stabilizing and maybe pulling back on interest rates. So we're going to have to watch this carefully. Stay tuned to these updates to see what happens. Let's go to the next chart here. Now, this is a very interesting chart. This shows the foreclosures pending in the years. Now, I'm sorry the check marks didn't carry over, but blue is 2015, 16, 17, 18, 19, 20, 21, and 22. So 2022 is, let me get my pen back here again, is this sort of, I don't know what color that is, hazel maybe, is this line right here. These are current foreclosures. And you can see they have been stable. They increased a little bit at the beginning part of the year, but not significantly. But you can see in the other years, they've been way up towards, 3,500 in the thousands. It's not there yet, and it doesn't look like it's going to increase, but of course, anything can happen. So let's compare these lines here with the lines that existed back in the crash year. So these top four lines here are 2008, 2009, 2010, and 2011. And you can see that in the 2011 period, that's when it started tapering off and the market started recovering. This area down here, were the prior lines that we were talking about as far as the market. Now, buried here in the middle somewhere, I think down in here, is 2022. So you can see that, just plain looking at this chart, foreclosures are very low. Now, will that continue? We'll keep an eye on it, right? If you start seeing foreclosures come up above this rack like this, then you'll see that we've got problems. I don't think that's going to be the case. 2008, this time period in here, was certainly a different market. There was people buying houses just like you would buy hotcakes at the store with no intent of living with them. And of course, they couldn't pay for them because of the lax standards in financing. That has all significantly changed. So we'd have to have a pretty significant event to create those sorts of foreclosures. So let's hope that continues on the way we are. That's why I don't believe there is a giant crash in our future. At least not right now. Numbers don't support it. Let's take a look at the average days on market that we spoke about a little bit earlier. This is active listings. It's in the green zone. and sold this month is in the green zone also. These are days on market. So if you look at the last 12-month sales, you can see that this was, the hot period down in here when days in market dropped down. I think it dropped down to like 19 or 20. But like I said, some houses were on the market for 2 or 3 days before they closed. So you can see it's crept up. We're in the 50s, 60s. So, in my opinion, a balanced market is anywhere between 60 to 90 days on market. So we're still in a little bit of a seller's market, but of course, these low numbers take a few months to wash out of the numbers so the average can come up. Last 12 months actives, we're right about, what's that, about 75 days on market. So I still think we're in a balanced market. I'm not convinced that this isn't a very good time to start looking at some real estate and getting qualified for a loan. So this next chart here is average sales price per foot. And just look at these prices per foot. It's crazy. It went up in the last year or so from 260 to over 300. That's an enormous increase. And of course, it's pulled down again a little bit, but it hasn't dropped below where we started a year ago. So for the media to say prices have crashed, in my mind, is a little overstated. Certainly, if prices get below $260 per square foot, that's what you call in the stock market a full round trip, and might have a little bit more concern. Look at the average over the last 12 months. There's that 240, 250 period again, and it shows over 285 on the annual average. So appreciation is still up, 6.7% is still the calculated appreciation on an annual basis, and on the change in annual average, it's still in the green. So people have a lot of equity. It's grown over the last couple of years. So I don't know anybody who's going to move because they want to throw away that equity away. So that's sort of where we are in average sales price per square foot. And then this is coming back to the summary. So I think we're in a balanced market. Anything can happen, especially with the Fed sort of increasing interest rates at a sharp angle. So that's what I think. I think we might see some more pullback. The numbers do not support a market crash like 2008, 2009. Here are some links for you. You can subscribe to this YouTube channel here. You can subscribe for newsletter subscriptions. I promise no spam. I don't like it when I get spam, so I don't send it out. And of course, you can get more online resources at jeffgreenrealtor.com. So I hope that helps. If you want to chat about any neighborhood, zip code, city, what's going on in your neighborhood, in outlying areas or Phoenix, don't hesitate to give me a shout. And I hope you have a wonderful day.